So in this segment, the ESRB's Advisory Scientific Committee awards the Ieke Vandenberg Prize to recognize outstanding research conducted by a young scholar on a topic related to the ESRB's mission. But let me give the floor to Loriana Pelizzon, professor at SAFE at Goethe University and vice chair of the ESRB Advisory Scientific Committee, and she will tell you all about the winner and the topic. Thank you.
Good. So thank you very much. It is a real pleasure, that we are having this event. So just to remind, this prize is indeed in memory of Ieke Vandenberg, and she was an advisory scientific committee member from 2011 till 2014. And she was really pushing for the idea that finance should serve society. And this is exactly based on this idea that, the Advisory Scientific Committee has decided to provide this award for research to young researchers that are doing research on systemic risk. It was, as every year, even this year, a very highly competitive selection process that we developed by involving peer reviews conducted by the different advisory scientific committee members. The process at the end has selected 4 papers, and then we made a collegial decision, and we selected the paper that, as you can see, Tsvetelina Nenova is going to present soon. I want just to tell you something about Nenova. She was a PhD student at LBS in economics, and now she's a researcher at the Bank for International Settlement. So clearly, we will see her around for many years, I'm sure, on this topic. I want just to tell you something about the paper that she's going to present. So the paper is a very interesting analysis of the international bond market and the role played in this market by non-bank financial institutions, mostly investment funds, via their portfolio rebalancing. So clearly, it is a topic that we have already started to discuss yesterday, and we will continue to discuss in a lot of other, let's say, meetings in the future. So clearly, she was really touching a very, very important aspect. But before that, she's going to present her paper. I want to that we are all applauding her for the fantastic paper that she did, and this is the prize that we are going to give to her. So thank you very much.
So much. Thank you.
Good. So since we are running late, I'm giving the floor to Tsvetelina Nenova, and she will present her fantastic paper, and then there will be time for questions. Thank you very much. Good.
Perfect. Thank you so much. This is a huge honor, and it's a privilege to be here and present my research to this fantastic audience. And I also want to take the chance to thank the ESRB and the scientific committee for just spending the time to look at the research produced by young researchers. This is invaluable for all of us. But let me jump straight into this paper, which is, as Loriana said, really a granular look at international bond markets. And why do we need this in the first place? Well, international bond markets are not only the biggest securities market in the world, but they are also the home of a lot of safe assets. So government bonds issued by advanced economies that serve the purpose of safe assets and facilitate financial transactions. And they also play an important role in the transmission of, as a first leg of transmission of monetary policies domestically and internationally. So in order to understand this transmission of monetary policy shocks, but also other shocks, we need to understand the rebalancing of investors in international bond markets. So this is the purpose of this paper. Now, the novelty here is really the new perspective that I take in order to understand this portfolio rebalancing, and that is through estimating carefully the demand elasticities of a particularly important sector, of a particularly important player in international bond markets, namely mutual funds. But let me take a step back. What do I mean here by these demand elasticities? I'm going to talk a lot about demand elasticities today. What I define here as the demand elasticity is how much portfolio weights of a particular bond respond to the change in the expected return of that bond or another bond. When it's the same bond, I call this on demand elasticity. So this is how much investors respond to a particular asset's return prospects. When it's the cross elasticity or substitution elasticity, that is how all the other bonds respond. All the other bond holdings respond to the change in one particular bond's return prospects or expected returns. Now, the on-demand elasticity informs us about the degree, so how big is the wave of portfolio rebalancing in international bond markets. The substitution elasticities inform us about the composition. And the substitution elasticities are also, from an academic perspective, the more novel contribution here, because it's very difficult to estimate substitution elasticities between many assets in international bond markets and allow for flexible substitution elasticities. So how do I do this? Well, I start from a very granular data set on the individual fund holdings of corporate and government bonds. The mutual funds that I have here, I'm sure you're interested in the particular financial institutions here, are mutual funds domiciled in the US and in the euro area. They invest in a broad set of corporate and government bonds issued by many different countries in different currencies, in different credit ratings, and different maturities. Really these are key players, a key vehicle for international portfolio diversification. So they, on their portfolio, on their balance sheet, you see many different securities that in terms of face value account for nearly 2/3 of global debt securities outstanding. So that is the scope. Looking back at yesterday's comments and the metaphor about the ego and the looking at the individual fishes from an ego's perspective, this is kind of what this paper is trying to do. Both have the, don't lose sight of the individual institutions, but have a very top-down view of global bond markets. So what can we learn from these estimates? Well, firstly, what I find is that different safe assets have very different properties in terms of transmitting shocks across global bond markets. US Treasuries are a global safe asset, and shocks to the return to these safe assets transmit or trigger rebalancing across global risky bonds. On the other hand, German bonds, the euro area safe asset or safest asset, causes regional rebalancing, and that speaks to a very clear market segmentation when we think about the role of different safe assets in bond markets. Secondly, when we think about what should be the central bank's composition of asset purchases, there the changes to the role of the changes to rebalancing between the safe assets and risky assets matters a lot. And what my results show is that this changes over time. In a financial crisis, there is flight to safety, but this flight to safety takes different forms depending on which safe asset you look at. And that means different compositions of central bank purchases may be required in order to alleviate stress in funding conditions for the broader economy. Third, I find it surprising that there is such high degree of market segmentation, especially in the bond markets of advanced economies, and in the euro area in particular. And this I think is important descriptive evidence on this that looks at really the portfolios of key international players. Now, let me go in terms of the contribution. This speaks to many different literatures. I'm not going to go through them in detail, but I think I should highlight here that in terms of methodology, I built on two important contributions by Ralph Koijzen and Motu Yogu. And on top of this methodology, what I really add is allowing for more flexible substitution elasticities. In this literature, what is difficult to achieve is allow, for example, for German bonds and Canadian bonds to be not the same in the views of investors in terms of substitutes for, say, US Treasuries. So this is what I try to achieve, is to relax some rigid functional assumptions that make for uniform substitution elasticities. But the way I do this is both through a very granular and detailed data set on the portfolio holdings of mutual funds and through a different specification. So let me start with the data set. I'm sure you are partly familiar, or some of you are familiar with with Morningstar, which is a provider of rating services for mutual funds. They gather a lot of information on the portfolios of mutual funds and other characteristics of mutual funds. And I take from that data set the portfolios of the mutual funds that are domiciled in those two currency areas, the US and the Euro area. And these are, over the sample that I look at 2007 to 2020, 11,000 individual funds. And they hold nearly, at the end of 2020, they hold $8.5 trillion of bond securities. This is what this is the pot of money that I will be looking at and how that is allocated across the globe. Now, in terms of what types of funds is in there, the most important characteristics that I'm going to distinguish between is where they are domiciled. Clearly, they care about returns in different currencies and are subject to different regulations in those two currency areas. So US versus Euro area-based funds are going to be different. Fixed income versus balanced funds or mixed funds might be different because they invest in different asset classes. And also, the set of funds I look at includes a huge variety of funds in terms of how active versus passive they are. There are ETFs that really have their index that they invest in and don't deviate that much from that. So I'm going to distinguish between, this is the beauty of the granular data, is that I can distinguish between all these different types of investors. Now, on the asset side, what they put money in, they put in money in a variety of different bonds issued in different places across the globe, in different currencies, and I will exploit that. I will group the bonds a little bit into 5,000 different types of bonds, and I will describe how investors substitute between these 5,000 types of different bonds along these key dimensions of the bond itself. Now, how do they allocate money across these bonds, these mutual funds? Well, they allocate a lot of money within their own currency areas, across the two big currency areas, and also everywhere else across the world. Now, this map just has some arrows to show you what the portfolio allocation looks like, but I'm going to have a empirical specification to understand this portfolio allocation. And what is that empirical specification? I start from a logit demand function. This is, as I mentioned earlier, what has been proposed in the asset pricing literature to study the demand of institutional investors in particular. I'm going to enrich this by allowing for these different types of funds to have different preferences for all sorts of bond characteristics. So here on the left-hand side, what I'm trying to explain is the portfolio weight that each individual fund I is allocating to a particular bond type, bond bucket N, scaled by the same thing, scaled by the rest of their portfolio, the bit that I don't observe. And that is a function of many things. I'm going to go through all the characteristics of the bonds and the investors in a second, but I want to highlight that in green, all the coefficients, all the parameters that describe the preferences of these investors are specific to a particular fund. This is important here. And why is it important? It's important because when we think about substitution elasticities, a fund that holds a lot of German bonds, for example, also is likely to prefer holding euro-denominated bonds in this data. That means that that fund is likely to substitute more towards other euro-denominated bonds when there is a shock to the return on German bonds than it is to substitute to US dollar or other currencies, for example. So it's important here to capture this heterogeneity in preferences. But preferences for what? Let me give you a quick overview of what funds care about or what I model them to care about. Firstly, they care about maximizing their the portfolio return So that means that they need to predict excess returns on different bonds and choose the bonds that are going to give them higher returns. So the first variable that I plug into this demand function is the predicted excess return on a given bond. That's a proxy of expectations about the returns on a given asset. Then they care also about risk, and in this broad context there are many risks. There's credit risk, there is liquidity risk, there is also currency and country risk that I take into account. And in addition to that, funds have mandates. They're not allowed to invest in just anything. So to capture that, I control for variables that capture what is their geographic area in which they're allowed to invest in, what is their preferences for a particular currency or a particular segment of the bond market, whether corporate or government bonds. In addition, I allow the funds to have different preferences in general over time for holding bonds versus cash versus equity. This is important because these funds are likely to experience funding shocks over time. That can shift the mix of their portfolio temporarily, and they're likely to experience changes to their risk appetite also, so that mops this up. So that means that what I'm left with here in terms of variation to identify these preferences of mutual funds is the variation within each fund portfolio across the different bonds in which they allocated at each given point in time. And so that's the idea. This is what I take to the data. What is the main objective of this exercise here is to really understand then what are these demand elasticities for different bonds. So I have heterogeneous demand elasticities across different bonds, and that really comes from the heterogeneous preferences for bonds of the different investors that hold them. And here, really, I'm going to focus today just on the second line, which gives me the substitution elasticity. So when there is a shock to bond K, say this is US Treasuries, US Treasury returns go up, then the funds are reducing their portfolio weights to other bonds to accommodate more of bond K or US Treasuries on their portfolios. Now, what they are selling the most depends firstly on how exposed they are to the US Treasury shock. Are they holding any US Treasuries on their portfolios? But also whether they are an important player in another bond, in the other bonds. So as I gave earlier an example, the funds that are very important investors in bonds are likely to reallocate more to other, also be important investors in euro-denominated bonds, and there the substitution elasticities will be higher, and that is scaled up or down depending on how return sensitive in general these investors are. With this in mind, I will go to show you what these substitution elasticities look like, but just let me pause quickly and address one challenge here in the methodology, which is that still at the fund level, the portfolio reallocation, there may be an unobserved component of demand shocks. So I need an instrument that is uncorrelated with this residual relative demand of each fund across the bonds in their portfolios. For that, that is not an easy thing to do. You're trying to have a supply shock in each quarter for 5,000 different global bonds in order to be able to identify the slope of the demand curve of all the investors. What I do in order to get an important, strong enough instrument that gives me variation in the returns on the global bonds is that I use monetary policy shocks. So these are high frequency surprises around monetary policy announcements of the two large central banks, the Fed and the ECB. The nice thing about these surprises is that they affect different parts of the yield curve differently during the period I look at. So I can match surprises to the short end of the yield curve to short-term bonds, and match surprises to the long end of the yield curve for both Fed and ECB announcements to the longer end, to the long-term bonds. And these surprises also, as documented in extensive international macro literature, tend to spill over to different extents to different countries and bonds denominated in different currencies. So that's that is what the shock that I'm using to shock the returns of the different bonds here. And so what can I learn from this exercise about safe assets and about fragmentation in international bond markets? Well, firstly, I'm going to look at what are what's the cross-section, what's the variation across bonds in terms of their substitutability with the two safe assets of the currency areas that I look at, the US and the euro area. So starting with the US, let me skip this in the interest of time. Oops, sorry. Starting with the US, when you have a shock to the return on US T-bills, what do the funds sell the most? Well, surprisingly, they sell mostly the riskier bonds, so the bonds that have a lower credit rating. Bonds, similar picture emerges when we look at the issuer regions or country risk. They sell bonds that are riskier US dollar denominated bonds, but also bonds issued by emerging market sovereigns. So there is a clear risk-taking channel to the shocks, to the transmission of shocks to the returns of the US safe asset. And there is also a global transmission that emerges here. Interestingly, when we look at the maturity, they tend to stick to the same maturity. So there is some degree of preferred habitat behavior in terms along the yield curve, but very much a strong risk-taking channel of transmission from US Treasury shocks. If that wasn't clear in a picture, that's what happens when there is an increase in the return on US Treasuries, portfolio rebalancing from all over the world, especially from risky bonds. Now, contrast that with German Bund returns going up. Here, the funds, here I'm talking about all the funds that hold German bonds, both the ones in euro area and the US. They tend to sell the most very similar bonds that are safe in terms of their credit rating, bonds that are issued by other euro area sovereigns, and again, bonds of a similar maturity to the bond that experiences the initial shock. So what does that mean? Well, the safe asset of the euro area has very different properties, and also there is very clear segmentation between the US and the euro area safe asset. There is, I didn't mention this earlier, but if you look at the spillovers, portfolio spillovers between the US safe asset and euro area safe asset, that is very small compared to these spillovers within the euro area and between US and risky assets. So very different pattern of, just to emphasize it in one picture, very different pattern of transmission of shocks to euro area safe asset, mostly within the euro area and a little bit to other advanced economy, but not so much to emerging markets or the US. All in all, this speaks to a very different rebalancing flows coming from different safe assets. And I think speaks also to a very surprising segmentation in what are thought of as developed bond markets, at least from the perspective of how these mutual funds behave. Now, second thing to think about is what about this portfolio rebalancing behavior over time? Does that change? Are there differences, for example, during periods of heightened risk? So we often speak about flight to safety, so preference to holding safe assets in bad times. But what my results show, especially on the different substitution elasticities, is that flight to safety is very different depending on what safe asset you look at. So indeed, if you look at firstly at US Treasuries, then this plot here shows the substitution elasticity between US Treasuries and a particularly big segment of the US corporate bond market. That's important for the funding conditions of the US economy, the BBB rated US dollar denominated corporate bonds. And this black line here shows the substitution elasticity over time and how that varies. When it goes up, it's negative. So when it goes up towards zero, they become less substitutable. So this clearly tracks very closely one popular measure of risk in global bond markets, the move. And it goes up during the financial crisis. So the substitutability declines between safe and risky assets during the financial crisis. Now, this has important implications for many reasons, that this type of flight to safety. But one reason is thinking about if you're sitting at the ECB or the Fed, and you're thinking about how to structure your quantitative easing programs during a period of stress versus in normal times, then this suggests that in normal times, you would get twice the portfolio rebalancing flow for the same amount of quantitative easing purchases of the safe asset. So safe versus risky asset substitution is not static, and it is state contingent, depending on the degree of market stress. And that's, I think that's interesting and specific to the behavior of these non-bank financial intermediaries in this setting. Now, secondly, I mentioned that the flight to safety is different depending on what safe asset you look at. And indeed, so this chart plots instead the substitution elasticity between German bonds and Spanish government bonds. And what I think is striking is that in the beginning of the Eurozone sovereign debt crisis in 2010, this also goes up, so drifts closer to zero. There is less substitutability between German bonds and Spanish government bonds. Similar pattern emerges if you look at Italian government bonds as well. Even French and Belgian government bonds become less substitutable with German bonds at the beginning of the Eurozone financial crisis. What I found especially surprising is that once the worst of the crisis is over and the ECB starts purchasing as part of its public sector purchase program both the core and periphery sovereign bonds, not much happens to this elasticity. It stays fairly low. So there is persistent fragmentation, at least from the viewpoint of these portfolios that I'm looking at of the mutual funds, in the Eurozone sovereign bond market. So I think that's also an important thing to think about fragmentation in the Euro area sovereign bond market and how that is related to the behavior of non-bank financial intermediaries. So with that, I just summarize what I said about the time variation in these substitution elasticities, and I think it's very interesting to think about how you design policies, monetary policies or policies trying to tackle systemic risk. Those should be state contingent and think about the circumstances and the asset-specific substitution elasticities. So to sum up, I think very interesting lessons here both for theory and for policy. Safe assets are very different. The behavior of these non-bank financial intermediaries with respect to changes in the returns of safe assets speak to puzzling market segmentation in developed bond markets. And I think this is a very interesting new way to think about bond market fragmentation and what that means for monetary and macroprudential policies. Thank you for your time and for your attention, and I look forward to your comments. Thank you.
Thank you very much also for being on time. And now we have time for questions. So, well, let me start with Thomas.
Tsvetelina, big congratulations, very well done. So, two questions. First of all, so the carry trades have been on the fore recently, and I wanted to understand. Sorry, now there's a bit circulation. I come here. So the carry trades have been in the focus recently. So how do you take into account the interest rate differentials between the major currency areas and also the expectations for that? And then also the timing that you were analyzing contained a lot of timing of quantitative easing. So if you could further explain how that was impacting the elasticities. Thank you.
Do you want to start to answer? Or?
Yeah, up to you,
Good.
As you prefer. So yes, I think that's a very, I didn't have time to go through the methodology in a lot of detail, but what I use when I look at the different bonds is indeed the relative returns in the same currency. So that takes into account the interest rate differential. Now, unfortunately, I don't observe the derivatives positions of the mutual fund, so I cannot directly measure how much they are involved in carry trades, because that often involves derivatives usage. But the relative returns are always measured in the currency of the investor. And then your second question, QE really helps me with the identification, to be honest, because it means that there are very different movements in the yield curve across the different maturities, because sometimes the central banks announce forward guidance or short-term changes in the interest rate. Sometimes they announce quantitative easing, and that moves more the long end of the yield curve. So that is really what I exploit in terms of the shock that I use in order to use some exogenous variation in the different returns of the bonds.
Yeah, but then the question is how, generalizable is your result? That's the point.
Yes, I mean, it is very much dependent on the type of shocks you observe. Here, to be fair, I only showed the substitution elasticities in the presentation with respect to shocks to the short end, the shortest maturity safe assets. I get similar results when I look at longer end safe assets. So if I look at the shocks to the 10-year Treasury or the 10-year German Bund, for example, there I see similar patterns in terms of the portfolio rebalancing, in terms of the substitution. So I wouldn't expect that to be the only QE to be that different and be the only driver of the different rebalancing.
Good. Please.
Linda Goldberg, Federal Reserve. So big congratulations on this well-deserved award. I guess one question I have is you in the beginning talked about relative returns mattering. You used that in your identification. But then you also talked about the importance of risk and different kinds of risk. And some would say that investors not just look at relative returns, but look at something more like a Sharpe ratio, which is influenced by the distribution of expected returns. And that in turn is influenced also by macroprudential policies. So just wondering about your thought, do investors really mainly look at the returns, or should there be additional work, other work? How do you think about the role of the distribution, the risks around that?
So the way I model it here is that I allow so I capture risk of the different bonds through all the characteristics related to the maturity, to the currency, to the credit risk, to the liquidity risk of the individual bonds. So all the sensitivity to the returns that I measure are conditional on the risk of those bonds. So indeed, I think that still that's exactly why the variations in the demand elasticities are interesting, because they are conditional on all these things that obviously the substitutability between a very risky bond and a very safe bond may be different because not just because of the expected return, but the risk that they have. But I think once you control for that different risk, this difference in substitutability really speaks to the imperfect substitutability of some bonds, and it speaks to a certain type of market incompleteness or market fragmentation.
Hi, Rafael Repulo from Senfi. How do you deal with exchange rate risk? I mean, some funds hedge and some funds don't hedge. How do you do it?
I think that's the plan for the next paper. As I mentioned, here what I assume effectively is that the funds don't hedge on average. So I assume that the euro area funds care about the returns denominated in euros, and I assume that the US funds care about returns denominated in dollars on all the different bonds. Now, there is going to be some hedging. My reading of the academic literature on what data there is out there about the hedging of mutual funds is that they hedge partially, especially bond funds. Equity funds don't hedge a lot. Bond funds hedge partially, and they hedge partially depending on what currency they're hedging exactly. The ones hedging dollars obviously hedge more because it's easier to and more liquid to hedge in dollars. The ones that are investing in emerging markets probably don't hedge a lot of their currency risk. So I cannot take this into account fully here. I don't have the data on their derivatives positions, but I think it is indeed very interesting to think about that.
Javier, and then.
Thank you very much for the presentation, and congratulations, Javier Suarez from CENFI and the ASC. It's a fascinating paper. I wonder, and you are the expert in this novel approach, to which extent we can interpret the elasticities that you estimate as the ones of a demand equation, as opposed to equilibrium holdings reduced form equation. Let me just give you one example of why I think it could be the second. The structural change that you observe after 2011 in the elasticity of the substitution between German and Spanish bonds, to which extent is the reflection that someone else in the market, namely the banks, have been discouraged to be there ready to buy the bonds, right? So in a sense, as an equilibrium phenomenon, if someone else in the market has less elastic demands or less reactive capacity to buy, in this case, maybe you have to be less elastic. I'm speculating, but you are the expert in the field, so just in case you have thought about it.
That's not how... I think you are correct that here I cannot sort of pin down the exact structural parameter that's causing this elasticity to change over time. It may be related to the characteristics of the mutual funds themselves, or it may be related to the characteristics of other investors in that particular market. Now, I'm a bit surprised. I would have thought that you would say that after 2011, the banks within the euro area become much more home biased and likely to hold their own sovereign bonds, so at least the banks in the periphery. So maybe we talk about this more, because I'm a bit surprised of the direction in which you thought about it.
Okay, please. And then I will move there. There is then the time for another question, and then we will go also for lunch.
Question.
Yes, I understand.
Sorry,
Please.
Dimitris Tsomokos from University of Oxford. As a sequel question to Raphael's question, how do you deal with default risk, particularly when it comes to emerging markets? Because as we know, the flight of quality in the bond substitution during the 1997-1998 crisis, the flight to quality was almost surely because of credit and default risk.
So for credit default risk, what I control for is the credit rating issued by the 3 largest rating agencies. Now, you may think this is moves a little bit slowly, but here I have quarterly data, so I would hope that by the end of the quarter, the rating agencies have updated their priors and their rating models. It's a little bit difficult in this setting to have a higher frequency credit rating or default risk measure, because it becomes also quite, if you do use credit default spreads, that's also has its own problems and has endogeneity issues also, including that. But
Good. So the last question. We are very close to lunchtime.
Thank you very much. Abdelaziz Rouaba from Central Bank of Luxembourg. I have only one technical question from what you show us, this variation of elasticities, demand side or substitution side. Usually, from empirical point of view, we calculate or estimate the elasticities in comparison with the average. And we will have 1 point in all the period we analyze. While here, the elasticity change from one quarter to another. This means that you calculate or estimate the elasticity in comparison of the end point. Did you think really that the elasticity change each quarter in comparison with the strategy of investor or investment funds? Thank you.
So here what I showed is the elasticity of the whole fund sector as a whole. So this is a weighted average of the individual funds' elasticities. It's not that the individual funds elasticity is changing all the time. It's more that the funds that matter for the elasticity, say, between the U.S. Treasury and corporate and the U.S. corporate bonds, the composition of investor changes over time. So, for example, one example is when you think about flight to safety in the U.S. context, there is clear flight to safety during the global financial crisis to the short-term treasuries, and during COVID also only to short-term treasuries. That is driven by, in this data set, it's driven by passive investors buying more treasuries in that period, during or the ones that have a low demand elasticity buying more. During the global financial crisis, it is mixed mutual funds, so those most exposed, I would think, to liquidity risk and redemption risk associated with the big decline in equity markets. During COVID, this demand elasticities for US Treasuries is low because there is a huge inflow from passive bond mutual funds, US passive bond mutual funds, so presumably channeling all these kind of excess savings in the first quarter of 2020. So these changes, quarterly changes in the elasticity is in aggregate a weighted average for the fund sector. It's not that each fund's elasticity is changing, it's just that who owns these bonds or the treasuries changes over time.
Very good. So we are very late. So I want really again to to thank for all the questions, but clearly for your presentation. I'm sure that this model will be used also potentially by the supervisor and the regulators to try to investigate the role of amplification effect and stabilization effect of portfolio rebalancing. But thank you very much.